The purpose of this presentation is to provide an overview of the policy events that have transpired in the residential housing market for the quarter, to provide an overview of the key trends in the residential housing market, and to provide an overview of the home price level for a select group of cities throughout the U.S. Before I begin, I would like to let you know that this presentation was produced by Troy Adkins. I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. Our company is not affiliated with any parties associated with the residential housing industry. As a result, the information and tools that we provide are objective and useful and offered exclusively to help prospective homebuyers make a prudent home purchase decision. In terms of my background, skills, and experience, I have more than 15 years of real estate analysis experience. I have more than 10 years of institutional investment consulting experience, and I have more than 7 years of freelance financial writing experience. Moreover, I am the author of more than 20 published articles, including publications by Forbes, Investors Business Daily, Yahoo, Investopedia, Financial Edge, as well as more than 230 news organizations worldwide. I have developed an internet-based residential real estate analysis software application that is marketed in the industry as the Adkins Residential Home Valuation Analyzer. Our software application utilizes proprietary finance-based and expense-based analytical methodology, which in turn allows prospective home buyers to determine the level of underpricing or overpricing of homes in their community, as well as accurately assess the costs associated with owning a home. Our goal is to offer a comprehensive, accurate, automated, user-friendly, and affordable residential real estate analysis software application in conjunction with contemporary information about the trends and events that are taking place in the residential housing market in an economical, efficient, and effective manner. Our commitment is to make Adkins Capital Management, the ARVA Residential Real Estate Analysis software application, and our residential real estate research the premier analytical source for prospective homebuyers to use in order to make a prudent home purchase decision. Now that I have provided an overview of my company and my background, skills, and experience, let me turn your attention to the primary events that have transpired in the residential housing environment. For the second quarter of 2015, the impact of foreclosures throughout the U.S. residential housing market was the primary topic of discussion. According to a report produced by CoreLogic, a recovering economy and healthier housing market has pushed the number of seriously delinquent mortgages to the lowest level since May of 2008. At approximately 41,000 completed foreclosures, the monthly total has fallen by nearly 2/3 since peaking in September of 2010. Completed foreclosures averaged just 21,000 per month nationwide between 2000 and 2006. Florida had the most completed foreclosures in the country over the past year, followed by Michigan, Texas, Georgia, and Ohio. Since September of 2008, 5.6 million homes have been lost to foreclosure. A comprehensive state-line analysis produced by the American Sociological Review, titled Neighborhood Foreclosures, Racial Ethnic Transitions, and Residential Segregation, provided a host of key foreclosure findings. According to the study, the U.S. housing crisis of the late 2000s was one of the most profound residential disasters of the past century. Between 2005 and 2012, there were 9.3 million unique visible foreclosures. Since 2008, roughly 1 out of 12 households have begun the foreclosure process. In terms of relocation, 33 million moves occurred between 2009 and 2010, up from $30.5 million between 2007 and 2008. The dramatic increase in moves has been attributed to the increase in foreclosures. According to a Federal Reserve study in 2011, among foreclosed movers, the vast majority relocated within their current metropolitan area. The burden of the foreclosure crisis was not evenly distributed, with Black and Latino households much more likely to face foreclosure than whites and Asians. The foreclosure crisis represents arguably the most substantial migration event of the past several decades, exceeding the Great Migration and the Dust Bowl Exodus. According to the State Line Analysis, the foreclosure crisis that hit the U.S. in 2007 was precipitated by a pernicious combination of unsustainable lending practices, irresponsible borrowing, and unrealistic expectations about the appreciation of real estate. Federal policy also played an important role in setting the stage for the foreclosure crisis, most notably in the form of banking deregulation that facilitated the use of high-risk lending and underwriting strategies, as well as federal efforts to preempt laws intended to protect consumers against predatory lenders. Foreclosures will likely have a profound impact on neighborhood distress and instability, leading to a density of vacant, neglected, and abandoned properties, heightening the appearance of neighborhood deterioration, driving up crime, and increasing the likelihood of racial transition. Moving away from the housing events to the housing trends for the second quarter of this year, it is important to note that the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan began the quarter at 3.88% and ended the quarter at 4.19%. Since June of 2011, the national average mortgage loan interest rate for a 30-year fixed-rate mortgage loan has been less than 4.61%. Most financial pundits expected the national average mortgage loan interest rate for a 30-year fixed-rate mortgage loan to increase slightly over the quarter. Recent comments made by the chairman of the Federal Reserve has led most financial pundits to believe that an increase in the key federal funds rate will likely take place by the end of this year. This in turn will likely cause upward pressure on mortgage loan interest rates in the future. With that said, the future level of mortgage loan interest rates will also likely be dependent upon the operating status of the government-sponsored enterprises and their future role in the housing market. In order to assess the price level of homes in a community, it is recommended that prospective homebuyers closely follow the level of mortgage loan interest rates in their community. And remember that a mortgage loan interest rate of approximately 5.3% will require them to repay to their lender twice the amount of their mortgage loan if they make their scheduled repayments and carry their loan to maturity. This fact illustrates the high cost of mortgage loan interest expense, which in turn has a negative impact on the price level of residential housing. In order to assess the impact of a rising interest rate environment on the price level of housing, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer. Now that I have provided an overview of the events and trends that have taken place in the residential housing environment for the quarter, let me now turn your attention to the methodology that is used to provide an assessment of the price level of homes in a community. In order to accurately assess the price level of homes in a city, the ARVA Residential Real Estate Analysis software application analyzes the relationship between the median home price level for the city and the median household income level for the city. With this information, the ARVA software application takes into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan, and the assumption that no more than 28% of pre-tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the ARVA software application can accurately assess the price level of homes in a city. From the first analytical perspective, the ARVA software application determines the level of underpricing or overpricing of homes in a city by calculating the mortgage loan interest rate that justifies the price level of homes in the city. With this information, the justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately assess the level of underpricing or overpricing of homes in a city. To illustrate how this first methodology is utilized, let us assume that the ARVA software application determines that the mortgage loan interest rate that justifies the home price level in a city is 6.5%. Let us also assume that the national average mortgage loan interest rate is 4.5%. With this information, homes in the city would be classified as underpriced because mortgage loan interest rates could increase by more than 2 percentage points before homes would be classified as overpriced in the city. Given this information, prospective homebuyers should reach the conclusion that it is appropriate to purchase a home in the city. From the second analytical perspective, the ARVA software application calculates the percentage of household income that would have to be spent by the people that live in a city in order to justify the price level of homes in the city. With this information, the ARVA software application compares the justified percentage of household income amount against the traditionally accepted household income amount of 28% in order to accurately assess the level of underpricing or overpricing of homes in the city. To illustrate how the second methodology is utilized, let us assume that the ARVA software application determines that the percentage of household income that would have to be spent by the people that live in a city in order to justify the price level of homes in the city is 48%. With this information, homes in the city would be classified as overpriced because the percentage of pre-tax household income amount would have to decrease by more than 20 percentage points before the price level of residential real estate property would be classified as underpriced in the city. Given this information, prospective homebuyers should reach the conclusion that it is not appropriate to purchase a home in the city. It is important to note that the ARVA software application allows prospective homebuyers to tailor their analysis to take into account specific household income amounts, home price amounts, cost of debt amounts, and percentage of pre-tax household income amounts. By tailoring their analysis to take into account these specific variables, prospective homebuyers can accurately assess the level of underpricing or overpricing of homes in their community. In terms of conducting residential real estate analysis by undertaking a historical assessment of U.S. housing trends, an interesting finding can be made by using the Adkins Residential Real Estate Analysis software application. For example, according to the U.S. Census Bureau, median household income was $52,250 in 2013 and $30,056 in 1989. In comparison, the median new home price level was $265,092 in 2013 and $120,383 in 1989. As you can see from the chart, it appears that a significant problem in the residential housing market has developed over the past 25 years, as new home prices have increased at a much higher rate than household income. Indeed, this issue could be a significant problem because most prospective home buyers obtain a mortgage loan in order to purchase a home, and they repay their mortgage loan with their household income. Therefore, household income and home prices typically need to move in lockstep in order to maintain a stable housing environment. With that said, the dramatic decrease in the national average mortgage loan interest rate for a 30-year fixed-rate mortgage loan in 2013, which was 3.98%, versus the national average mortgage loan interest rate in 1989, which was 10.32%, brings to light some key points that prospective homebuyers need to consider. For example, when people look at the relationship between median household income and median home price levels for 2013 versus 1989, there would likely be more concern about the residential housing environment in 2013 due to the pronounced mismatch between the median household income level and the median home price level during that time. However, due to the much lower cost of debt in 2013, only 29% of household income would have to be spent by homeowners in order to justify the median new home price level in that year. Moreover, the national average mortgage loan interest rate for a 30-year fixed-rate mortgage loan would only have to trend down from 3.98% to 3.7% in order to justify the home price level. Therefore, while on the surface it appears that a mismatch between the median household income level and the median new home price level was a material problem, based on the justified percentage of household income amount and the justified mortgage loan interest rate amount, the median new home price level was only slightly overpriced for the nation in 2013. In comparison, in 1989, the median household income level and the median home price level appeared to be more properly aligned. This in turn would likely lead people to believe that the residential housing environment was stable in that year. However, given the high cost of debt for a 30-year fixed-rate mortgage loan in 1989, 44% of household income would have to be spent by homeowners in order to justify the median new home price level. Moreover, the national average mortgage loan interest rate would have to decrease substantially from 10.32% to 5.75% in order to justify the median new home price level. Therefore, while it appears that the relative alignment between the median household income level and the median new home price level in 1989 was satisfactory in terms of maintaining a stable housing environment, based on the justified percentage of household income amount and the justified mortgage loan interest rate amount, the median new home price level was significantly overpriced for the nation in 1989. Now that I have provided an overview of how the Adkins residential real estate analysis software application is utilized, let me provide an overview of the home price level for a select group of cities across the U.S. For the second quarter of this year, 26 cities that make up the Adkins 60 City Home Price Index were classified as overpriced for the quarter. The top 5 overpriced cities were Bridgeport, Honolulu, New York City, San Francisco, and Los Angeles. In terms of a relative price level analysis, it is important to note that it is not possible to justify the home price level for the top 5 overpriced cities by reducing the national average mortgage loan interest rate from 4.19% to 0%. Therefore, in order to classify the homes in the top 5 overpriced cities as underpriced, it would have to be deemed prudent by prospective homebuyers to spend more than the respective justified percentage of household income amounts, or the respective median household income level would need to increase to the appropriate level that is within the range of $88,295 and $156,010. As a last observation, based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs for a mortgage loan, the justified home price level for the top 5 overpriced cities would need to fall within the appropriate level within the range of $168,810 and $333,498 before homes would be deemed appropriately priced in the cities. Prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to accurately assess the level of overpricing or underpricing of homes in their community. On the other side of the spectrum, 34 cities that make up the Adkins 60 City Home Price Index were classified as underpriced for the second quarter of this year. Detroit, Wichita, Sioux Falls, Little Rock, and Wilmington were identified as the 5 most underpriced cities in the index. In terms of a relative price level analysis, the national average mortgage loan interest rate would have to increase from 4.19% to more than the respective range of 7.3% and 19.7% before homes would be classified as overpriced in the cities. As an alternative, the justified percentage of household income amounts would have to be deemed as an inappropriate level for homeowners to spend in order to repay the principal and interest costs for their mortgage loan. Prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to accurately assess the level of overpricing or underpricing of homes in their community. Given the events that have transpired in the residential housing market this century, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home, prospective homebuyers should subscribe to use the ARVA Residential Real Estate Analysis software application in order to accurately assess the level of underpricing or overpricing of homes in their community, the largest amount of money that they should spend in order to purchase a home, and the amount of money they would need to earn on an annual basis in order to be able to afford to purchase a specific home. In addition, prospective homebuyers should subscribe to use the ARVA Residential Real Estate Analysis software application in order to be able to accurately assess total home ownership costs expressed as a percentage of household income, and to be able to determine how much a home would need to appreciate in value each year in order to offset the costs associated with owning a home. By analyzing residential real estate from these perspectives, prospective homebuyers should be able to make a prudent home purchase decision. For more information about the Adkins 60 City Home Price Index and to access the Adkins Residential Real Estate Analysis software application, please visit the Adkins Capital Management website at residentialrealestateanalysis.com. Thank you for taking the time to listen to this presentation.